All right, let's do it. Welcome to this event at FX Street. Thank you very much to Vicky and anyone else at FX Street involved in inviting me back. I used to do these events maybe twice a week, maybe more often, 2 or 3 times a week. And I got sucked into a new role, new obligations at FX Bootcamp, and maybe I say that with a tone, which you can probably read between the lines what I mean by the tone. I'm doing some things at Bootcamp that are different, and my time is otherwise preoccupied doing things that are still interesting to me, but I miss spending more time with traders. I miss spending more time, frankly, talking about some of the issues that are moving today's markets, and I miss especially interacting with the attendees at these FX Street events, because I'll call as I see it, as even if it risks ruffling some feathers at Bootcamp. You guys are more talkative bunch these days than some of the folks at Bootcamp are these days. I don't get it why. At Bootcamps, some of the Bootcamp crowds become very quiet, and you guys are, I should say guys, not just gentlemen, but ladies here. You're a very interactive, very participative bunch, and I appreciate that and I always enjoy it. And it's not just for my ego, serving my ego in terms of, and I don't have much of an ego. It makes for an interesting interaction from my perspective, conducting the webinar, but also I learn something when people ask questions, and I learn something when people offer some things they're hearing, some things they're seeing, whether it's on the charts or something fundamental news or whatever. Anyway, let's get past that. Welcome to this event. Let me first remind you the purpose of this event is education. I'm not going to provide specific trade alerts or recommendations, but I will provide some usually medium and longer term technical and even fundamental analysis. We'll take a look back at some things that have happened more recently. You can even take a close look at what's happened just today. But the real focus of the webinar here, and I don't want to overlook that, is to contemplate, or maybe I should say just identify some specific things that you as a currency trader can focus on, be it technicals, and of course my specialty is more of the fundamentals, the news flow and such, things that could shape the price action on any individual currency or currency pairs and through the rest of this month, if not even longer. Hey, Connie. You the former bootcamper, Connie? If so, good to see you again. Seriously, good to see you again. So has anyone noticed, let's start with today. Anyone notice what's happened today, not just in the currency market, but in multiple financial markets? Today has been a very, very historic day. Very historic day. Actually, I would call this a very historic week, starting with Sunday's elections in Europe, not just in France, but even in Greece. Let's take a look at the charts first. All right, old pals, yeah. I'm looking at a weekly chart for the euro, and I probably should shift this chart to the right a little bit. Yeah, I've zoomed on this weekly chart, and you can see this low here that the low of this current weekly candle happens to be the low of the day, low of 2 days, today being Wednesday. And you can see that low below the lows established over much this year at or just below 130, the psychological level. Let me put a line at one of the lowermost lows established in February, around 29.80. We're below that now. So really the lowest point, let's go to the daily chart now. We'll give you some different perspective on this. We've hit the lowest point today on the euro that we've seen since January 23rd. Now, what has led the euro to this point? Why has the euro dropped, well, not just today, but really this week? We had a brief update on Monday after a gap established between Friday's low and Monday's Asian session open. But it's been down ever since. Well, if you look at the charts here, we've got a series of lower highs working here, which I can identify with some reddish arrows. There you go, series of lower highs. So, a question that might, there's a bunch of different questions circling in my mind right now, so I don't know where to start. Let's start with this. I'm going to start with a question I'm sure many of you have been pondering. How has the euro held up so long? Is anyone else wondering that? how has the euro managed to hold up for so long above that horizontal blue line, or more generally speaking, above, let's put another line at 130, because that's really the key area per se there. I'll make this a black line at 1.30. Surely I'm not the only one pondering that. In fact, I know I'm not. I'm just wondering if I'm the only one in here pondering that. Oops, I'm just going to make that black. Why is the euro held up above 1.30 for so long? I mean, things have been pretty nasty in Europe, and increasingly so lately. Any thoughts on that? Believe me, I've got a few thoughts on it, but I wanted to see how smart some of you are. And I know there's enough participants in here that I bet the one or two have a theory, and probably a very good one. And by the way, any theory that any of you espouse or anything that I mention, it's largely speculation as to what's really holding up or what really drives at any time or over any period of time any currency or currency pair. Yeah, Gam, you hit the nail on the head for me when it comes to a lot of price action in the currency market. It's all relative. It's all relative. Yeah, Harley mentions media propaganda. Yeah, Spin Doctor hits one that I especially wanted to emphasize. Well, Gam mentions two. QE3. What does that mean? Many of you know what it means, but for those who don't, that's another so-called quantitative easing program. The Federal Reserve, the U.S. Central Bank, has pursued two major programs, and I guess you might call the current Operation Twist a relatively minor one. Two major programs pursued by the Federal Reserve. The first starting in late 2008 after the bankruptcy of Lehman Brothers. The second one starting in November of 2010, I believe it was. That's QE2 program, so-called QE2 program, was hinted at by Ben Bernanke in a speech at Jackson Hole, Wyoming, in late August of 2010, that same year. What these programs have, what the Fed has looked to accomplish with those programs, they've done things like buy U.S. Treasury securities, in other words, buy U.S. government bonds, and especially in the first program, they bought some mortgage-backed securities to support the U.S. housing market. A simple way to put it, it's not the only way. Well, actually, I'll put it in a couple of different ways. Because I want to make a second point, because it's relative to what we're seeing in the equity markets. One thing the Fed wanted to do, as I see it, was keep longer-term rates lower. By lowering longer-term rates, for example, you do support, among other things, the housing market. Some of you may have noticed that mortgage rates, U.S. mortgage rates, in other words, loans for buying a home in the U.S., are based on, at least in part, on longer-term Treasury yields. And as the Fed buys Treasury securities, especially mostly from the major U.S. banks, that support for U.S. Treasury prices means yields go down. As yields goes down, you tend to see a drop in U.S. mortgage rates. Lower U.S. mortgage rates makes mortgages cheaper, or housing or monthly payments for home buyers lower, and then makes it more affordable for more people, hopefully, to buy homes. Now, there's a lot more to the housing market, a lot more headwinds in the housing market other than that, but that's one thing that the Fed's moves were intended to do, is to support the housing market. And also it makes actually a lot of borrowing rates lower. Makes it cheaper to borrow all kinds of different money, whether you're an individual consumer or a corporate, a company. So there's that. The Fed, as it often is, looks to stimulate the economy by lowering different kinds of rates. The Fed had already, through late 2008, after the Lehman Brothers bankruptcy, taking its classic monetary policy tool, the Fed funds rate, down to virtually zero interest rate policy or ZIRP. The current range established in late 2008 and in December of that year was to take the Fed funds rate between 0 and 0.25%. So once the Fed did that, the next question was, what else could they do? Well, the Fed took down the essentially brought shorter-term rates low at the end of 2008, but with these quantitative easing programs, they've brought down longer-term rates, which again are the basis for several different types of the rates for several different types of loans. Again, an effort to help stimulate the U.S. economy. Another thing the Fed has done is to, with these quantitative easing programs, is to essentially drive investors into riskier assets. If you look at, especially today, if you look at the yields on some of these longer-term Treasury securities, there's not a lot of appeal, at least certainly not nearly as much appeal in buying the longer-term Treasury securities. The yield isn't there, the return isn't there. Prices near historic lows, prices near historic highs, yields near historic lows. So in order to garner a return, investors are driven more and more into something which would yield a greater return, and that something has become more commonly equities. And by driving investors into more and more investors in equities, the hope is that the Fed, at least one of the hopes of the Fed, as I see it, is to create a so-called wealth effect. As equity prices drive higher, those with investments, even if it's only in their retirement accounts, those with investments in equities will feel wealthier, and those who feel wealthier tend to act accordingly, whether it's invest in new business or spend more money as an average consumer, whatever. Now, the effect of that in this environment is debatable, but I'm just stating what's the intent or what's the hope, if you will, of the Federal Reserve in doing what it's been doing. So let's bring those home. So that this describes some of the intentions, or at least maybe some of the hopes behind the Federal Reserve in its prior quantitative easing programs. In terms of movement in currency prices, it usually goes like this. I'd say usually for a reason. It doesn't always go like this. It usually goes like this. When a central bank does something to in the direction of a type of accommodative policy, a type of easing policy, an example of that is lowering rates. A more common recent example is more quantitative easing programs, buying government bonds or buying other types of assets, like for example the Bank of Japan has done recently. When a central bank does something in that direction to stimulate an economy, it's usually a negative for that respective nation's currency. So again, one thing that seems to have given some recent support to the Euro USD is the idea that the Fed is still of a mindset to unleash another round of quantitative easing if conditions dictate it. And Gam, if your point Gam is that Gam makes a comment about pushing on a string. What's meant by that is that a simple way to interpret the phrase "pushing on a string" when it comes to a central bank doing something again like more QE by the Fed, or if you look at the Bank of Japan has unleashed more and more easing programs or more its asset purchase program. The idea is this, that the effectiveness of monetary policy, or put another way, the monetary policy loses its effect as you do more and more of it, or can lose its effect as you do more and more of it. The idea is, when it comes to the Fed's quantitative easing programs, is that QE3 many think will be less effective than QE2, which was arguably less effective than QE1. But right or wrong, what the market seems to still respond to is the prospect or not of changing policies at these major central banks, like the Fed, like the Bank of England, like the ECB, and even sometimes like the Bank of Japan. I'll get to the Bank of Japan in a little bit here. I want to make sure that I cover some of the recent things the Bank of Japan has done, and bring some context to how if the Bank of Japan could do anything more in the future to influence the Japanese yen. I rather doubt it, but it's something worth talking about. So, in my typical long-winded, maybe too detailed fashion, I hope I explain why one theory behind why the euro has held up. Another theory beyond the idea of the prospect of QE3 by the Fed limiting any gains in the dollar against the euro. Another theory is this, that there's been some more than a few European banks, specifically as I'm hearing and reading, banks in France, possibly selling some U.S. dollar-denominated assets. And as banks in the process of their so-called deleveraging, essentially a lot of European banks, and actually maybe more than just a lot, most of them are going through what's called a deleveraging process. These banks have accumulated far too many assets relative to their cash or their cash on hand, relative to their capital. So what these banks are probably going to be looking to do over the course of time, maybe over years, is to reduce, well, a combination of both really, reduce assets and increase capital. And depending on the bank, depending on the country, some banks are having better luck than others at recapitalize. But let's just use an example of French banks, because as I see it and hear it, French banks have been cited. That's one common set of banks that have been doing what I'm about to describe. As French banks, for example, have sold some, for example, U.S. dollar-denominated assets. They receive dollars for whatever assets, like loans they sell, and as what they'll do with those dollars is convert those dollars into euros, and that conversion process has been a source of, at least for now, temporary support for the euro, as the theory goes. So some refer to it as repatriation by Eurozone banks, specifically French banks. Now, could there be more to in that? One of you mentioned China buying euros, or China maybe buying some other European assets. But back out from that a bit, and you could call it diversification. Continued diversification out of dollars. What a lot of central banks especially in Asia, have been doing is they will actually buy dollars effectively to at times to weaken their own currencies. But when these central banks in Asia buy dollars, they end up with an outweighed amount of dollars relative to their overall portfolio of foreign exchange reserves of currencies. So in order to rebalance their portfolio of currencies, what they'll do is swap the dollars for another currency. Rebalance their weight of dollars. And at the moment, like whether central banks like it or not, one of the most viable alternatives to the dollar as a closest thing to a reserve currency in the world is probably the euro. So the euro benefits from that as well. Yeah, again, that's Julia's comment about assets. So anyway, we've talked about that, and so those are some of the things that are that many think are holding up the euro USD. Buying euros, but to rebalance foreign exchange reserves by, for example, Asian central banks, a possible repatriation trade by some eurozone banks, and the lingering prospect of QE3 by the Fed. Well, and I should add another one. If it's related to the QE3 trade or the prospect of QE3 by the Fed. If you look at the ECB, they did do that massive LTRO program announced in early December, launched on December 21st, and the second long-term refinancing operation by the ECB was on the last day of February 29th. It's although it's arguably a form of easing, which someone would consider a euro negative, it actually helps stabilize, for now at least, for at least in the meantime, the eurozone banking system. So it became was interpreted, at least for now, by the market as a euro positive. But if you look strictly at the interest rates, what the European Central Bank has not done yet is lower its main rate, its overnight rate. The ECB is still at 1% versus the Fed, which is at again, like I said earlier, is your interest rate policy, your ZIRP. Fed's rates at between 0 and 0.25%. So you've got an interest rate differential, favoring euro USD up more than down, at least for the moment. But now things are, taking a different form here. We've got, concerns about Europe coming to the forefront again. You've got the change in the political guard occurring in multiple countries. a socialist that was just elected in France for the first time in, 30 years? More than 30 years? You've had some issues in other countries. Was it the Netherlands recently had some troubles passing a budget, approving an austerity-driven budget there. Greece has had these elections. The two political parties in Greece, which have been in control for some 30 years, they didn't get anywhere near the share of votes they used to, and now you've got a party which has not been had much popularity for a long time, has found some newfound popularity. And let me cut to the chase here when it comes to Greece. The situation with Greece is that you don't have any appearance. Let me get this down to a short time frame. I'm sure you're tired of looking at a daily chart. Growth rising. What you have in Greece is an unpredictable or an uncertain political situation. So what does that mean? Well, a lot of countries, especially at the insistence of Germany, have been asked to pursue, to varying degrees, so-called austerity policies. Cutting government spending, especially. And such an approach was initially seemingly embraced for a while there by multiple Eurozone countries, especially France alongside with Germany, France formerly led by Sarkozy. Now you've got a situation where, it's been brewing for a while, one could argue, and now it's kind of come to a head where enough citizens, enough Eurozone countries are saying no more. We don't like this approach. We don't want austerity. We don't like the effect it's having on our well-being, our employment or lack thereof. So if officials in various countries which formerly signed up or agreed, maybe unwillingly, to austerity measures, these former leaders are now losing their jobs, and new leaders who were elected in large part, in many cases, on the back of an anti-austerity platform, may now take a different tack when it comes to how they collaborate with Germany. So what you have is, again, spreading political uncertainty in Europe, and the idea that Europe may not all, the major European countries may not all sing the same tune as they appeared to be doing, at least through much last year. And let's say, one simple point: markets do not like uncertainty. Markets hate uncertainty. So now there's a question of when it comes to like Greece, for example. Greece has Greece and the so-called Troika, representatives from a combination of the European Central Bank, the International Monetary Fund, and the European Union. The so-called Troika organization came to terms with the former Greek leaders on some austerity measures that Greece would put in place there. Again, austerity measures meaning cuts in government spending and among other things, but mostly cuts in government spending. Well, now do you have the old leaders at Greece have effectively lost their job, and no government per se operating in Greece right now. You tell me, is it very likely that Greece is going to do some of the things it promised to do in terms of these austerity measures? I would argue not. In fact, if you listen to the leaders of the political parties who garnered a good deal of the votes, or not a good deal, but at least earned more votes than what they previously did. I forget the name of one of the political parties that I can actually look it up real quick. It starts with an S. It just escapes me the name of this party. But anyway, one of the parties that attracted a great deal of a good portion of votes, more so than used to. The thinking is that, what they're expressing is a desire to not go along with the austerity plans agreed to by the prior government. In fact, there's one of the leaders has said that they would they'd rather not make any scheduled debt payments or just they don't want to agree to something like about much anything when it comes to what the prior government agreed with the so-called Troika and the rest of the European leaders. So my point is this: right or wrong, the market is perceiving a greater a heightened risk that Greece might actually leave the eurozone. Now, for now, that's it's perceived as a euro negative. Now, here's the question to ponder in the not so much the days to come, but the weeks and maybe months to come. And we had a discussion about this at Bootcamp earlier, although rather limited because it seems like some traders at Bootcamp were preoccupied with indicators and such in the charts. But I'm not here to discuss indicators. I want to ask some of you the question. This topic, the answer to this question, as the market figures it out, if in fact we see an increasing probability that Greece leaves the eurozone, the answer to this question, or the market's search for an answer to this question, could very well dictate price action on this pair for not just weeks, but maybe months, who knows, maybe even years to come. If Greece were to leave the eurozone, it's a possibility. It's not a prediction on my part. It is a possibility. Would that be a positive or a negative for the euro? That's a question I believe the market's going to be posing more and more in the coming days or weeks as we look ahead here. Is that a positive or negative for the euro, Greece leaving? The knee-jerk reaction for most traders, maybe not most is a strong word, maybe for many traders is, it's a euro negative, right? Yeah, but some of you cite positive Greeks, and I would agree. Gert, you're probably closest to the way I would put it. Gert says long-term positive. I can see that, and here's why. This can entail a lengthier explanation, but I'm going to put it in a simple way. We have 17 Eurozone countries right now, 17 countries in the Eurozone. Let's say not just Greece, but maybe over time, another or one or two leave. The weaker countries leave. When you have one or more weaker countries leave, what you are left with, you would think or hope, is a stronger remaining bunch, a stronger core of Europe. Another way to look at it is whatever downside the euro has seen in the past, not just weeks but months or so, that downside could be due in large part to the weaker countries dragging the euro down. You take away one of those weaker countries like Greece out of the picture, what you're left with is a set of countries at least a little bit stronger that would justify a higher currency, in this case the euro. So that is one school of thought, that the euro, at least in the medium, at least in the long term, maybe in the medium term, could be positive if and when Greece leaves. Here's my word of caution to all of you, and it's something I'm pondering myself when it comes to interpreting what a Greece departure. If we see more and more clues about this, if the market decides, initially right or wrong, that Greece is getting closer and closer to leaving the eurozone, what does it mean for the euro? The wild card, as I see it in that theory, is this, or that could destroy that theory, is this: contagion. What does Spain do? What does Italy do? Especially Spain. Spain's, by the way, one of the reasons why the euro is down today. It's not just Greece. It's a Spanish story. Anyone see the Spanish bond yields? The Spanish 10-year was back about 6% at least earlier today. Consider, for example, especially the Spanish banks. What if Spaniards see what's happening in Greece? If Greece is going to leave the eurozone, readopt their old currency, the drachma, and what you have there is a situation where the Greeks, at least when Greeks recently, when the Greeks who have withdrawn their money from Greek banks get the money in euros, at least there you know what the euro can buy you. What's the value of the euro? Lots of questions as maybe not. At least more than a few questions about what the new drachma would value. What would be the valuation of the new drachma if in fact that were adopted? You don't know if you're a Greek if you have what the new document is going to what's going to get you. How much buying value, how much inherent value will that new currency have? Spanish consumers, or maybe not just consumers, maybe even some businessmen or companies see that, see Greece going through that scenario, or seeing Greece maybe increasingly likely to go through that scenario, and think, I don't want to go through that. I don't like the uncertainty of the currency, my currency being changed, not knowing what's going to buy me. I'm going to take my money out, at least take some money out of the Spanish banks. Or if you're Italian, same thing. In other words, what I'm getting at is there could be at least a moderate run, maybe on select Spanish banks, maybe on select Italian banks, but that's a distinct possibility. And I see Money Magnet mentions Germany leaving. That's another one, too. So what I've discussed up to this point was the prospect of a weaker country like a Greece leaving. Maybe there's one or two more over the coming years. Another possibility that's been espoused by many is that you see a core group of maybe 3-4 countries or more. Maybe it's a solo job by Germany. I don't know, but the idea is that the stronger countries would leave and either take the euro with them, or maybe if it's a small group of countries, they readopt some like altered Deutsche Mark. I don't know, Germany's old currency. Anyway, this is stuff that could take easily years to play out. But it's stuff that I can tell you that plenty of traders, especially at hedge funds, are pondering right now. Pardon my pause. I'm going to check some of the yields in Europe. Where's the Spanish 10-year at? Ooh, 607. Well, actually, the high for the day is 609. Ooh. Yeah, many euro. I like the way you put that, Spin Doctor. So I'm actually pondering what to talk about next. If there's anything else I want to discuss along those lines, I would say this, folks. There's I've seen some estimates that well, first of all, there was something posted earlier today that the EU might be considering withholding the 5-point-some billion euro next payment to Greece. The deal, the aid, the financial aid agreed to back in March for Greece. There was a 5-some billion euro payment due to Greece scheduled for tomorrow. And there was some chatter earlier today, and that the EMU was considering withholding that, considering the political uncertainty and some of the comments being made by political leaders and party leaders in Greece. But when it comes to Greece, let's consider this. We've got, I'm seeing and hearing estimates that Greece, assuming that it gets that $5 billion payment tomorrow or soon, Greece, by some reports, has enough money to take it through maybe next month, at least some part of next month. If Greece does not manage to form a government, even if it does, if the Greek government does not manage to satisfy the so-called Troika's requirements for reforms or austerity measures put in place, and there's a whole host of them, a big long list of them, Greece could may very well not get that aid payment, that financial aid. And in that case, Greece cannot pay a good chunk of its government workers. You have pension obligations not being met, and things could potentially implode for Greece, where it just has to leave the euro and reshake things fairly quickly. June becomes, I think, a key month for Greece. By the way, I don't think it's confirmed yet, but it looks increasingly likely that a new government in Greece is not going to be formed. And if that's the case, then you're probably going to have another second round of elections in, I believe, like second week of June. So there's one thing to watch when it comes to the what could affect not just the euro, but even multiple financial markets, even multiple currencies. If you have if Europe is back in the spotlight to stay here for a while, not, if it is, and that could weigh on some so-called risk currencies like the Australian dollar, even like the Canadian dollar. And by the way, the British pound could very well continue to be a safe haven. That depends on what the Bank of England does come Thursday at their next meeting. If there's no clues from the next Bank of England meeting, then 2 weeks from today, you get the next Bank of England meeting minutes. Those would be very telling as well. And I'm actually running short on time. I can run a little bit past, depending on how much leeway the fine folks at FX Street give me. But I have a lot more topics to cover than just Europe. But I wanted to give you the gist on the. I'm not very good at giving the gist because I feel like I go to too much detail sometimes. But a lot again, I wanted to focus a lot of attention on what happened today because today was a very notable day. Not only did the euro make new multi-month lows, but we also had gilt yields. The U.S. Not the U.S., but the United Kingdom 10-year government bond reached an all-time low today, just below 1.9%. Germany's government bond yields, the so-called Bund, Germany's Bund, briefly broke below 1.5%. Folks, these are yields on government bonds in the UK and Germany. We've never seen yields so low. Never seen yields so low. All-time low yields established today. So that's why I said it's an historic day. The U.S. 10-year yield did reach a level just below 1.8%. The all-time low on the U.S. 10-year yield, around 1.67%, I believe, established last September. So anyway, but my point being, risk. That's definitely a risk-off environment today, and we'll see if that continues. Well, I promise to look ahead, so I'm looking ahead at a few things. Number one, has anyone trade the Australian dollar in here? The Australian dollar has been under pressure. Let's take a look at that pair. Actually, let me before I'm switching the charts to the Aussie. Let me look at some comments, make sure I haven't figured anything. Yeah, Spin Doctor says that the changed government will not evade the issue. Totally agree, Spin Doctor. Totally true. Wiki says talk fast. Wiki, I don't know if I could talk much faster, although I do tend to sometimes. Again, what happened to French yields? Fed yields up a bit today, but not that much. So even France had yields were up today, just much like Spanish bond yields, but not nearly to the same degree. See, I mean, as I see it, I don't have access to all the yields across the government bond markets in France, but it looks like Germany is one of the only major bond markets whose yields were down. The Italian 10-year was up today. The French 10-year was up today. The Spanish 10-year definitely up today. I mentioned the Italian 10-year yield up today. And I'm not surprised the French 10-year yield is up because there's a reason to be concerned about, France's situation. I've read some article in France, and France, there's some, there's problems in much of Europe, not just France. But anyway, I digress here. So the Aussie this week reached a weekly M1 pivot point. Aussie fell to a point just maybe 20 pips above parity, 1.0. Wow, we did bounce back up that trend line. Now, my point on Aussie is this. So many of you may already know that the Australian Central Bank last week cut rates by a more greater than expected 50 basis points or 0.5%. And there's certainly a possibility that over time that central bank in Australia could cut rates by more. That's an Australian dollar negative. We've seen some negative data out of, or some weak economic data out of China. For example, the HSBC China PMI number for the manufacturing sector in that country has been below 50 for several months right now. It's actually a mixed bag because if you look at China's official PMI numbers, they've been above 50 for several months, so it's kind of confusing. But also, if you look domestically, there's some other signs of weakness in China. Not China, but in Australia. One thing is you've seen some of the prices for new homes, specifically in new home sales in Australia, have been dropping regularly over the past more than a year now. Also, there was a comment made or outlook provided just, I don't know if it was yesterday, it might have been the day before, by a couple of the major mining names in Australia. A couple of the major mining firms in Australia, BHP for one, Rio Tinto I think is another, talked about lowering the investments they're going to make in new mines. And the reason for that lower investment seems to be, at least due in part to, an outlook for slower growth from China. So you have some things weighing on the Australian dollar. I mean, number one, the Australian dollar tends to be one of those risk-on, risk-off currencies when the global financial markets, that is, are more concerned about the global growth story. And when you see many major global stock markets dropping, the Australian dollar tends to drop anyway. Well, another factor is when it comes to a currency is central banking policy, as I mentioned earlier, in reference to the dollar and to the euro. In the case of the Australian Central Bank has recently cut rates a little more than expected, and some think it may be due to do more. And so these things and then weigh on the Australian dollar. In addition to, I mentioned the earlier weakness, signs of continued weakness in China. That's a big deal because China is Australia's biggest trading partner. I haven't checked the latest data, but last I knew, China seems like I believe Australia is the destination for something like 25% of Australian exports. No other country. Australian exports more Australian exports, especially resources, go to China than any other country. So if China slows down, that could certainly weigh the Australian dollar. So the question in my mind is where to from now? Well, until we see things like equity markets stabilize, until we see the situation in Europe stabilize, it's fair to assume that the Australian dollar is going to be under more pressure, at least in the near term. Now, in the medium and long term, you're going to need to see things like data from China improve. Also, it would help to see the Australian Central Bank sound a little less dovish, and it'll take a little time for that to happen, though. There is a jobs report coming up from Australia during the next Asian session, and rather than just talk, I've been talking a lot of big picture, and I'll talk big picture for at least the next 10 minutes and longer, depending on how much time FX Street gives me. But I want to give you something to chew on for the next Asian session, for those of you who do trade the Asian session. I do see a potential opportunity, if we get a better than expected jobs report from Australia, to fade that news. Oh, 5 minutes? Okay. Ooh, I gotta work fast. I've been under much more stricter timer constraints, so no worries. Thank you for the heads up, Maud. I'll tell you what, I'll post a preview on the blog, our blog at fxbootcamp.com, of this Australian jobs report. But my point is this: I can see a possibility where the Australian dollar rises on the back of, if we get it, a better than expected jobs number from Australia for the month of April. But then the market might fade it, meaning that I can see a scenario where the Aussie rises briefly in response to that report, maybe over the first 1 or 5 minutes, and then flips from up to down as that rise is eventually greeted by one of these sellers. And one level that stands out to me right now, just looking at this chart of the Aussie USD, let me put a horizontal line there, right about there. I call it the 10085 to 1.01 area. Can you see why I've put a line there? Again, I don't know where the Aussie is going to be come today's Asian session. I don't know if we're going to see a better jobs report, better than expected. I don't know if the Aussie will manage to rise that high. But it seems a real possibility, especially given how, I can tell you what, I can imagine this. What if the Aussie drips lower to about the horizontal blue line at 45? Typical move in response to a better than expected Australian jobs report, about 50 pips in the Aussie USD, about 50 pips up. I can imagine drop down, maybe we find the Aussie around 1.0040, 1.0050 in the early part of today's Asian session. What if we get a better than expected jobs number out of Australia? Aussie rises about 50 pips, meets that horizontal black line at around 1.0090, maybe 1.01 psychological level, then flips. That's as close as you will ever get from me of a trade call, of a prediction. I don't like making trade calls. I don't like making predictions. But I'm telling you, historically, that sort of thing has been fairly common on the Aussie USD. Now, some of you may think, well, why would that be an Australian dollar positive? And initially, yes, an Australian dollar positive, but I've seen plenty of occasions where, in the context of a broader trend, in which case this is the broader trend is down for the Aussie USD. There's still lingering concerns about Europe. There's still concerns about the growth story in China. In that context, I've seen more than one occasion where a positive jobs report has sparked a brief rally on the Aussie USD, which the market has sought to sell into. And of course, given the theme down in the Aussie, if the jobs report's worse than expected, all bets are off, and we could be, sell the Aussie again. Yeah, I see you covered about plotting the downfall of the world. I feel like I haven't done you guys justice. I got just a few minutes of a late start, given the HawkCom issues and the password issues, and I'm having to wrap up a little bit on the early side. Again, no worries with the folks at FX Street. I mean, I got to keep this schedule here. Well, I don't want to dive into anything else because any other topic I dive into, it's going to take me at least 5 minutes to discuss. So I think, I'll leave you with this note. Bank of Japan intervention. I'm not predicting that it's going to happen. There are some clues in place which suggest that it could happen in the coming days or weeks. It's a possibility. In the terms of, in the realm of, use an analogy of weather, tornadoes are unfortunately fairly common in the U.S. Whatever part of your world you're in, but there's a tornado watch and there's a tornado warning. Tornado watch conditions are increasingly ripe for a funnel cloud to form. Tornado warning means a twister has been spotted, but it maybe hasn't touched ground and hasn't done any damage. I feel like we're not tornado watch, or at least a storm watch when it comes to prospective Bank of Japan intervention. Quick reasons why, and I'll wrap up with this. Number one, dollar yen, for example, at levels where we've seen intervention in the past, namely the coordinated G7 intervention following the earthquake and tsunami in March of last year. That occurred at about 79.50. Today we bounced in the dollar yen at 79.50, currently at 79.60. By the way, the 79.50 area was the high of this pair following the last intervention at the end of last month. I'm sorry, not the end of October. I'm referring to, and I'm real quick, I'm about to wrap up. I'm referring to that high right there, near the middle of this chart. So that's one thing. Bank of Japan just added more to its asset purchase program, did more QE. I know the boosted its QE program by the Bank of Japan often preceded an intervention. Japan also committed a notable amount of money to the IMF, specifically for Europe, if Europe needs it. It seems to me politically that move by Japan could grease the skids for intervention, which would be seen in the normal conditions as self-serving. What I haven't seen yet is explicit comments by Ministry of Finance or Bank of Japan officials. Usually, and I'll wrap up with this. I promise I'll wrap up with this. Usually, you will hear some reference to decisive action in the currency market. I remember before the coordinated G7 intervention in March of last year that an official in Japan made reference to doing battle with the currency market. I mean, I'm looking for a term like a definitive, bolder term from Japan. Japan officials not known for taking bold actions using bold terms. But if and when we see a Ministry of Finance or Bank of Japan official using more bolder terms in reference to the currency market, that could very well precede by 2 or more days an intervention. With that, I bid you adieu. Thank you very much for your participation. Thank you very much to FX Street for letting me do this. And I hope I'm invited back very soon so I could talk about some issues that I didn't get a chance to get to. Sorry, I apologize. I do ramble on when it comes to some issues, but I just take this stuff too much. I think I read too much. I get too much stuff to talk about. Have a great day, folks. Cheers.